Hello, everybody. Welcome back. Um, you remember that we are at present talking about tax exemptions concerning to cross-border services. And today's small chapter is about the exemption for cross-border transports related to exports and other services which are directly related to goods of exportation. Yeah, and you find the relevant rule in paragraph 4, number 3 of the German Umsatzsteuergesetz, the USTG. You remember paragraph 4 is a very, very long list of a bit more than 30 exemptions from value-added tax. And number 3, so among those which the makers of the law regarded as the most important ones, so that is why they mentioned them among the first ones. This number 3 is the rule which we are talking about, the exemption for cross-border transport. The first thing which we need to mention is that this relates only to goods which are exported, and also other services than transportation are free if they directly relate to goods of exportation. And there is additionally also a parallel rule for the cross-border transportation of goods and other services, which relates to imported goods if the costs for these services have been included in the tax base for the importation VAT, which was levied on these goods by the customs authorities. Well, now what's the idea behind these rules? With regard to the goods which have been exported, the idea is relatively easy. Exports will always be taxed in the country of destination with their full market value. And their full market value is usually consisting of all the costs which were involved or combined with their production. So every cost relating to the exported goods will, in all probability, be included in the value, in the price or market value which these goods have at the border of the country for which they are meant. So they will be taxed with their importation VAT. And now that all the price and all the cost elements of an exported goods are free of the tax of the countries of origin, that could not be guaranteed if the costs for shipment of these goods, so transportation, could be taxed. So imagine an example. We have a seller of goods in the inland. That seller sells to a foreigner for, let's say, 1,000 euro a product. Here we have a foreigner, and that foreigner now wants to get the goods, so foreigner orders a haulier to bring the goods from Germany to the foreign destination. So the haulier does indeed this and charges additional 200 for the transport. So if VAT were charged, then it would be 238 if VAT would be charged on the cost of the transport. And so the foreigner would buy the goods with 1,200 euro net price plus 38 VAT in the costs of acquisition of the foreigner, and that would be a violation of the basic ideas of the system. Exports should be completely free of VAT in the price and in all cost elements. So it would also mean a distortion of the market, because if the seller bought the service of the haulier, paid it himself, the seller would get the VAT, the 38 euro, back as input tax refund and could sell to the customer abroad for 1,200. And so we would have a distinction of comparable cases, which would not be justifiable. Note, by the way, that this example can only work with certain kind of customers, because when it came to taxability, we already said that first is usually to check if the place of the service is in the inlet. So if the foreigner who orders the service of the haulier is a foreign entrepreneur, then the place of service would probably be under the basic rule of 3A2 in the foreign country, so no taxability in the inlet. So transport would be free of tax already at the level of taxability. So only if we have a customer for whom that rule does not apply, there we have the problem at all. So basically for a private customer who orders the transport. Well, so basically this exemption has been established for every cross-border transport. It is mandatory under the EU rules, so it exists in all other member states of the EU. So if the cross-border transport of a good which is going to be exported covers also parts of other EU territories, the transport will be tax-free there too. However, the service is only free if the transport relates to goods which are exported. Goods which are exported are all goods which are declared as an export to the customs authorities when they leave the customs territory of the EU. So even if you have things which you don't sell to a third country, but just bring permanently to a third country without selling them to others, even these goods are exported. So even there, the tax exemption would apply. So if, imagine a German firm brings a crane to a building site outside the EU for its permanent own use there without selling it, so without a delivery, then the transport would be under 3A, 2 taxable in Germany. However, it would be free of tax under our rule of 4(3). When it comes to other services relating to goods of exportation, they are free of tax due to the same logic. All cost elements combined with production of exported goods should be free of tax. However, it is demanded that the services must directly relate to the goods which are exported. So just to say, well, a part of my general costs, let's say 1%, also relates to exports, that's not possible. There must be a direct relation between the service and the good which is exported. So if we have a truck which brings apples from Germany to a shop in Switzerland, and that truck breaks down during the journey and the truck must urgently be repaired, that would not qualify for our exemption, because the repair does not relate to the goods which are exported, these are the apples, but only to the truck. And this is no good of exportation because the truck will come back, and so not tax-free. No application of our rule. If meat is going to be exported to a foreign country, and before being exported, the meat has to be inspected in order to obtain a certificate that it complies with all the health regulations in the country of destination, then the inspection directly relates to the good which is exported. The exemption of 4(3) can apply. Last remark, 4(3) does not apply in cases where other exemptions might prevail or might apply, which are granted under other conditions or with other consequences. For example, the last sentence in 4(3) explicitly underlines that if you obtain an insurance contract for a good which is exported, then the insurance contract will be free of VAT. However, the applicable rule is then not 4(3), but 4(10), the general exemption for insurance contracts. The difference, by the way, is under 4(3), the person who sells the service would be entitled to input tax refund for all the cost elements which he or she bought in connection with the production of the own services. whereas if something is tax-free under the insurance contract rule, it's a tax exemption which is combined with the effect that the input tax refund is not granted. So it is indeed a thing which matters under which exemption you here get, under which rule you here get the exemption. The same with the rule on job processing. If you have work done on a good which is then exported, you have a direct connection of the service which is done to a good of exportation. However, there is this more special rule, the rule on job processing. We talked about that. And if you don't meet the, let's say, strict conditions of that tax exemption, you can't invoke instead the rule of 4 number 3. That makes sense, because otherwise the conditions laid down in paragraph 7 USDG for job processing would make no sense, because they would never limit the scope of the exemption. That was the overview over the exportation cases. The next important field of application for 4 number 3 is there, as already mentioned, cross-border transports and other services which directly relate to goods which are imported into the EU, if these costs have already been included in the tax base for the importation, VAT. And now that sounds a bit strange, because in general the idea is that exports should be tax-free and imports should be taxed. So everything which is imported, there seems to be no justification that cost elements here should be left tax-free. So that sounds strange, and we should first try to understand why that can be a reasonable idea. The background is as follows. When you establish a system of VAT at the border for importation VAT, then your idea is you want to guarantee neutrality between the imported goods from outside and the goods which are sold in the inland by a trader or a producer or so, who is fully subject to inland VAT. So tax neutrality is the idea which you try to achieve. So what does that mean in reality? Imagine we have a customer in the inland. That customer wants to buy a computer and wants to buy a computer from a foreign brand. So customer is not really willing or able to order from abroad, so we need an inland trader, probably at the same city or location. That inland trader now goes to a foreign producer, gives him a call or a mail and says, I want to have a computer. The foreign producer wants to earn for his computer 2,000 net. And then that computer must be transported to the location of the inland trader. That transport is now, let's arbitrarily say 300, probably far too high, however, it doesn't matter. Each number is equally good if we have a fictitious example. Now what matters is that one of the two, either the trader or the producer, will have to pay for the transport. What does that mean? Either the producer pays, then the producer will insist in that the price for the inland trader will be not 2,000 but 2,300, because otherwise he would make a loss. The other alternative is the foreign trader takes 2,000, but then the inland trader has to pay for the transport. So in that case also the inland trader has cost of 2,300. In any case, an inland trader in the city where the customer lives is not able to sell that good to the final customer for less than 2,300 plus VAT, because naturally 2,300 are the trader's costs, and the trader is fully taxable and liable to tax, so has to add VAT to his net price. And so 2,300 is the minimum price which can be charged as net price plus VAT. If we want to avoid any tax cost advantage in cases of direct import by the consumer, this is our example with which we have to compare. So the tax base for the direct import by the inland consumer should also cover the net value of the imported computer plus the cost of transport, because every inland alternative would consist of these cost elements. And that's the reason why the customs duties authorities calculate the importation VAT tax base with these two elements. They ask you for the price and they ask you for the cost of transportation. Now, basically, we have two constellations to distinguish. The first is the foreign seller pays for the transport of the customers to the customer's address. In that case, the tax base can easily be determined because then the foreign seller must have included the cost of transportation into his calculation. So you can take the sales price as tax base. Let's illustrate that. The foreign seller has to calculate his price as follows. We have the net price of the computer, 2000. The foreign seller has to pay for the transport to the German border, then from the German border to the address of the buyer, in total 300. Complete price charged to German customer will be 2,300, and you can add the VAT then on that amount because the price already covers all cost elements. Here, so if it's free customer's address, well, then it's clear that the cost of transportation do not need to be added to the price. They are included. However, second possibility is that the net price is charged and the cost of transportation have to be covered by the customer. In that case, you will have to add them. Because imagine we have a customer from Munich, he buys a foreign computer for the price of 2,000, and then has to pay for the transport to Munich another 300. Then the tax base should be determined as 2,000 plus 300, which leads to 2,300 net, and that entails a 19% VAT at the importation declaration, which ends up with a gross burden of 2,737 for the Munich customer. That's exactly the price for which he or she could buy the same in a shop in Munich from a trader. So that only guarantees neutrality. Now, that would be the tax base. However, if you now have a haulier, and that haulier makes the transport from the German border to the customer's address in Munich, and that cost of the transport would also be taxed at the haulier, then we would have a double taxation. We would have taxed these costs in form of importation VAT, and the haulier would be forced to charge a cost price. So if it can be proven that these costs have indeed been included in the price for the importation VAT, then the haulier's transport from the border to Munich is, although it is taxable under 3B1 or so, it is free of tax. Again, here the first test must always be if the service is taxable at all. That's not always the case. It depends on who the customer is, if it's an entrepreneur or a private person, or depending on different circumstances. So never forget to test taxability first. Good. Same logic then naturally applies to the cost of other services which are directly related to imported goods. So if these costs were included in the calculation of the importation tax base, they must be left free of tax in order to avoid a double taxation of these costs. So the service rendered by the entrepreneur in question has then to be treated as tax-free. Condition is again that you can prove that this has been included effectively by the customs authorities and that no error was committed. So we have a kind of a guarantee that at least once the VAT will be taken. Again, we have a rule which regulates the relationship between this tax exemption of 4 number 3 and other exemptions. And again, it's the same rule. Tax exemptions under 4 number 10, for example, for insurance contracts for the goods moved. Here the insurance rule prevails over the general rule of 4 number 3, and also job processing or so, if ever applicable, would be prevailing over 4 number 3. A third possible field where 4 number 3 could be applied shall only be shortly mentioned, just for the sake of completeness. It might also happen that goods are temporarily imported into the inland under the supervision of the customs authorities, for example, to be worked on here, job processing, and then be re-imported. In that case, we have goods which basically are meant for export again in the long run. And so the logic of the system demands that these goods should also be left free of tax. And in that case, so when you have goods which are temporarily imported under supervision by special permission of the customs authorities, then services rendered directly relating to these goods during their time in the inland are also free of tax. Makes sense. So, having heard all this, we can probably, and I hope, indeed now understand what 4 number 3 tells us. The following services are exempt from tax: cross-border transportation of goods, cross-border transportation of goods by railway, and other services if those services are directly related to goods of exportation or to goods of importation which are transported to third countries in the external transit procedure, goods which are imported and then pass through the territory of the whole EU and leave it again. So these are also a kind of just passing through, so they are not meant for the inland, so comparable to exported goods. Or which are directly related to goods of importation which are imported into the territory of a member state if the costs for those services have been already included in the tax base for the importation tax. Some small exemptions. And then I left out B and C as here too specific, but important is again that the provision is not applicable for the services named in numbers 8, that's financial services. So if you give it credit financing the whole affair, then for number 3 does not apply, but for number 8, 10 and 11 is insurance contracts and brokering services relating to these insurance contracts. And then job processing is also mentioned as something where for number 3 does not apply to. Important is that the fulfillment of the conditions must be proven by the entrepreneur who claims the exemption, and that the Federal Ministry of Fiscal Affairs has the right to order by a regulation how the entrepreneur has to give the necessary proofs. So not every proof is permitted, but probably you have to present some forms or explicitly described documents. Well, that's enough for today. I hope you keep in mind a general idea of the rule. You will not very often need it. However, it's nice to know that it exists because it's one of the few tax exemptions which are of general interest in a cross-border context. Thanks for watching, and I hope I can see you and welcome you back soon on the channel. Thanks and goodbye till next time.